Welcome back, class. This is a video for Chapter 2 using financial statements. In this chapter, we're going to be talking about what the financial statements are, who uses them, and so forth. There are many ratios that we'll use within financial statement analysis to figure out exactly how a business is doing and what they're doing. So when we talk about ratios, usually they break into one of these four categories. Liquidity, which is basically the ability to meet obligations and generate revenues. Solvency, which means long-term obligations and generate future revenues. Profitability, the ability to provide financial rewards to attract and retain financing. And then market prospects, the ability to generate positive market expectations. Now, liquidity is usually measured by comparing assets to liabilities. And in this case, you have the current ratio, which is simply the current assets divided by current liabilities. That means all assets that are expected to last only this current year are compared to all liabilities that are expected to be due this year. And that really measures liquidity, or how liquid a business is. Solvency, on the other hand, measures the total debt ratio a company is carrying, and the total liabilities, which includes both current and long-term liabilities, are divided by the total assets in the company. And then in this case, that basically tells you how much debt obligation they have. Profitability is usually measured by a profit margin, which is usually a percentage, because we're taking the net income and dividing that by net sales just to see what kind of return we're getting when we actually take out all the expenses and so on. So that here is a 21% for Apple. That's a really good profit margin. And then when we talk about market prospects, the price to earnings ratio basically is going to compare the price per share on the market, what you would pay per share, and divide that by the earnings per share. Now, the earnings per share is really just taking this net income and dividing it out by all of the shares of stock that are outstanding in the company. So if you have a lot of shares of stock outstanding, this earnings per share number is going to be small. Here it's $8.35, which is fairly high. I mean, normally it's in the cents. You're not over $1 on many large companies that have a lot of shares of stock. So depends on how many shares are outstanding and what kind of profit they have. Here, Google's price to earnings ratio is 27.25. But in this case, we were looking at Apple. Their price to earnings ratio is 13.50. So, I mean, those are basically ratios that are used to analyze how a company is doing in their financial statements. Business transactions and how we actually get to a financial statement is what the rest of this chapter is about. We have asset accounts, we have liability accounts, and equity accounts. We talked about these in class on Friday, and you remember there are lots of different kinds of asset accounts. Only a few liability accounts we're going to talk about in this class, and then there are several equity accounts. So we're basically going to put our account system or our accounts under one of these three general umbrellas. But when we talk about asset accounts, we're talking about cash, accounts receivable, notes receivable, any kind of a prepaid account where we are paying for something in advance, supplies that we purchase, equipment, buildings, land. Land, by the way, is an asset that does not depreciate, and basically it usually stays on the books pretty much forever under this one particular cost, unless you actually sell it or do something else with it. Liability accounts are basically those things that we owe. Most of the time, we're going to be concerned with accounts payable, notes payable. Accounts payable are the normal day-to-day operations, and a notes payable would be something we would sign at a bank. Unearned revenue accounts are where we are going to identify revenue that we have not earned yet, but we've received. And then accrued liabilities are amounts that are owed but not yet paid. So we're basically looking at these liabilities in advance, recognizing we're going to have to pay those someday, but we don't have them due yet. The most common types of accrued liabilities are interest and taxes when we think about those. Equity accounts we've talked about before divide into four main categories. Common stock, which is the shares of stock that are purchased by the shareholders that own our company. The dividends, which represent a return of some of the income to the owners. Revenues are those things that we earn when we provide a service, and expenses are those things that we spend basically for utility costs, wages, and so on. This categorizes what I just described to you in more detail. We have also a way of basically organizing these accounts. We're going to call the chart of accounts. And in the chart of accounts, you'll see this in many times in a business where they have asset accounts. They'll number systematically. So like 100 accounts are assets, 200 liabilities, 300 equity, 400 revenues, and 600 expenses. Any numbering scheme can be used, but many times in larger organizations, you'll have possibly 4 or 5 digit account numbers in order to track a larger number of accounts. We talked about debits and credits on Friday as well, and basically the only thing you need to know about a debit and a credit is the debit's on the left side, credit's on the right. You're looking at the abbreviation of DR for the left on the debit side, and the right side, credit side, CR. So we'll basically abbreviate that way when we're looking at these T accounts most of the time. But in a double entry system, what that means is for every debit, we're going to have a credit. For every credit, we're going to have a debit, or at least one debit in response to a credit. Many times there will be compound entries where we have one entry on the debit side and perhaps two entries on the credit side. So in the case where we buy something with cash and credit, we'll have a debit for the asset we purchase, a credit from cash, and a credit on the liabilities side. Here is an expanded model to show you the normal balances in these accounts. We went over those Friday, but again, here is a really good illustration of that in Exhibit 2.7. Assets, remember they group together this way. Assets, dividends, and expenses all increase the debit. Liabilities, stock, equity, and revenue all increase the credit. So this model here, you can think about DR as EAD, which is the normal balance side for expenses, assets, and dividends. So you can't spell the word dread. On the other side, the credit balance will be equity, revenue, and liabilities. So think about those things in that way, or think about how you would organize that. When we journalize entries, we're going to identify what a debit is and a credit is, and we're going to record it in a journal. And the journal is just an organized way of recording original transactions by date. It isn't really very useful for knowing how much we have in any given account, but it does give us a day-by-day record of what transactions occurred. They begin here with these debits and credits, and the format in a journal is a date. Debit is the first entry, and then you indent to the right for the second entry to identify what account that is. The debit goes first on the left. The credit comes second on the right for the dollar amount. So you're looking at this formatting. Now, when we go to the ledger, we're going to use what is a sort of an expanded version of T accounts, where we have a debit and credit in this general ledger account, but we also have a third column, that's the balance column. So in this case, we're recording a debit of $30,000, and we show the credits coming out that reduce the balance that we had in the beginning. So we recognize those credits as reductions to that balance. And by the way, when you have an account like this, a T account or a general ledger account, you're very interested in maintaining this running balance. So you can at any time determine what kind of balances you have in each individual account. So when you record the ledger, you then go to the journal, you then go to the ledger, posting the debits and credits in the appropriate account, and you're going to record the account number that you posted in right here in the PR column, the posting reference column. There's a good example here of how they do journal entries. I'm not going to go through this in detail because we'll go through this in class, but you go through the journal entries and then post those into the ledger accounts. They show you what steps you're following here in each one of these cases to record a journal entry and then actually post it into the ledger. The ledger they're using here, or the way they're identifying a ledger, is using a T account, which is what we will do most of the time in class. I find it's much easier to actually keep track of that way. Now, when we summarize transactions in a ledger, we're basically going to total each side, which they call footing, and then take the difference between the two, and the balance will go in the column that's the larger of the two. You notice here in cash, we have a normal balance as a debit, but their balance here is as a debit balance of $42.75. We'll always want to see cash with the debit balance. Supplies, an asset account, prepaid insurance and equipment, those are all asset accounts. Liabilities, typically you'll see accounts payable with a credit balance, unearned revenue with a credit balance. In the equity section, common stock with a credit balance, a debit for dividends, always a credit for revenues, and then debit expense for the expense balances that you'll see here. And so there's the total, and this, by the way, this is how we track maintaining the balance in the accounting equation. But probably the biggest way that we're going to verify that we've done the debits and credits correctly is in the preparation of a trial balance, that we're going to go through these T accounts back here that they show. We're going to pull each one of these balances into a trial balance. So this T account here with a debit balance, you'll see comes down into this trial balance with a debit balance. We're going to list out all the assets first. Those will have typical debit balances here. And then when we get to accounts payable, we're going to switch over typically to credit balances. Now, when you're doing a trial balance, the most important thing is you get the balance of the account that you're looking at in the right column, so the correct column. So debit column on the left, credit column on the right. The goal here is that when you get done with all of the debits and credit balances, you will have the same amount in each column, debits and credits. Therefore, you know that you've posted all the journal entries correctly and that all the debits and credits balance out. You can verify, we can look through, if we find an error in this, Most typically, one of the biggest errors is going to be to put a number in the wrong column. Another error may possibly be to switch around or reverse two numbers, transpose them. And we can talk about how to find those errors in class. Now, financial statements are prepared in a specific order. And when you go through the financial statement preparation, we're going to go through preparing a income statement first. Here we are. We have a trial balance. The first thing we're going to prepare is an income statement, which looks like this. We're going to have revenues and then detailed expenses. Deduct those from revenues, we get net income. That then comes down to the statement of retained earnings, where we begin with retained earnings of 0, add in net income, subtract out dividends. Our ending retained earnings will be whatever the balance is there. And here we have a balance of 330. That will then go into the balance sheet with the common stock to present the total equity amount that we have. So the beginning financial statement is net income. The second one is retained earnings. The third one is the balance sheet. And in the balance sheet, we're going to identify the assets and total assets, the liabilities. We're going to bring in common stock, the balance there, and whatever we calculate in retained earnings, which will be basically the net income minus any dividends that we pay. If we begin the month with a prior balance in retained earnings, we'll add that in as well. So that really is chapter 2, and we're going to go through more of this in class tomorrow or on Monday. So if you have any questions, be sure to let me know, but I look forward to seeing you back in class.